Hello, my name is Mark Fleming-Williams, and today I'm joined by John Minnich to discuss the global economy. John, it's been an interesting week, month, 7 years in the global economy. Obviously, there's been a lot going on, and it seems to be stemming a large part from China. So as the East Asia analyst, potentially you can give us a quick rundown of the latest events coming out of China.
Sure. So there are two main recent events that we've been watching in China. The first, which has been running for the last 8 weeks or so, is the stock market decline. And that is more or less the product of we had over the course of 2014 and into 2015, Chinese stock prices rise some 130% on average. And in mid-June, they began to fall. And since then, they've tumbled 40%. So that's been one event we've been watching. The second was the Chinese government's decision in early August to reset the way that the yuan exchange rate works with the dollar, the yuan pegged to the dollar. And that's had the practical effect of devaluing the yuan somewhat over the course of the last 3 or 4 weeks. So those are the two recent events we're watching, and they've sent jitters through the global markets, and they've had their impact. But it's important to remember that these both are part of a much longer running process, which is the Chinese slowdown, the slowdown of the economy. And that itself is part of a longer process, which is China's transition from an export and investment-led economic growth model to one that they hope eventually will be grounded in domestic consumption. And the heart of that process so far has been the winding down of this investment and construction boom in China.
Absolutely. And this is where the global economy comes in, because obviously China is massive and is now hugely influential. It's the second largest economy in the world. And so as a result, these emerging markets, the rest of the emerging markets, which have been piggybacking off China's success to an extent, to the extent that the commodities that they sell have been largely going into this kind of Chinese engine. So as that's been slowing down, then we've seen an awful lot of these emerging markets, which have grown very far, are now really struggling. So we've seen the currencies fall over the last 3 to 4 years as the commodities market hit its peak in 2011.
Right, and now we're in this uncomfortable position in emerging markets where on the one hand they're reeling from the effects of China's economic slowdown, the way that that's hit iron ore prices, coal prices, across the board, commodities are down. At the same time, emerging markets are being hit by anticipation of an interest rate hike from the U.S. Federal Reserve. So how is that going to play into this process of, hitting at both directions? What's that going to mean for the global economy?
I mean, yeah, as you say, it's a nightmare for the emerging markets. It's all happening at once, perfect storm. But the interesting development is that this Chinese currency change, which you mentioned, actually makes it likely that the Chinese yuan is going to start heading downwards. It's only gone down kind of 2 or 3% so far. It's probably going to continue heading downwards, which means that the US now suddenly finds itself alone with a strong currency. And if it does raise rates, as the market expected to in September, then it could see its exports really hit. I mean, America is not as reliant on its exports as many other countries in the world, but still being alone with a strong currency could hurt it. So suddenly the markets the expectations have pushed back from September, could be December, could be October, but it could even go into next year. So these Chinese moves are having huge effects all around the world.
So we have on the one hand a weakening China with a depreciating currency. At the same time, we have a strengthening United States with, on the whole, a strengthening dollar as well, and the anticipation of the Federal Reserve rate hike, which may not come in the next 3 months, but is sort of an eventuality that everyone's anticipating. Yeah. What about the rest of the developed world caught in between? So we have on the one hand Japan and Europe, both of which have been struggling with many years of economic stagnation, and both of which are trying to sort of ignite their economies, push themselves out of that stagnation with their own formulations of quantitative easing. So what's happening in China, especially with the yuan, and what's happening in the U.S. play back on the decision-making process in Tokyo, in Berlin, in Brussels?
Well, it probably creates more problems, basically, for the Europeans and the Japanese. As you say, they are quite tied. They've both got these aging populations, and they're both facing similar kind of slowing, high debt kind of economies. And so both have been pursuing these quantitative easing strategies, which a large part of it, although they can't say it because it looks like a currency war, but a large part of it is to weaken their currencies. But now what we're seeing is these Chinese, the emerging market currencies falling as well naturally, and the US perhaps delaying their rate rise, which will mean that the strengthening will happen more slowly. So suddenly these European and these Japanese central banks, which have been buying bonds like crazy, suddenly, despite their best efforts, are seeing their currencies begin to float upwards anyway. So the big political question comes as to do they redouble their efforts? Do they double up on QE, which Japan has already done? I mean, Japan specifically is in this big political experiment, which doesn't seem to be working. They're trying to raise exports. They're trying to raise inflation. These things aren't really happening that much. So the question comes: they already own a large quantity of the bonds already available in the market. How much can they double up, even if they want to? Mm-hmm. So yeah, all these moves out of China, they are affecting the calculus in every single government around the world at the moment.
Mm-hmm. And I think the important thing to remember is that there is the story of the real economy in China, and then there's the story of things like the stock market. And the stock market is not insignificant in context of the broader question of where China's economy is going, but it's also not that significant. It's important to set it aside to understand what it means for the rest of the Chinese economy. And the reality is that, for instance, in the last couple of months, we've actually seen parts of the housing sector improve in China. So we've seen home prices and home sales rise in roughly half of the cities surveyed by the Chinese government. And what this reminds us is that China is a massive, very big economy undergoing a very significant transformation that will have profound effects on the global economy. It's important, though, not to get caught in the headlines of the up and down day-to-day movements of stock prices in China, and to remember this underlying transition process that's going on.
Indeed. We'll be keeping a close eye on China going forwards. Thank you very much for joining us. And for more information on this and any other topics, please visit stratfor.com.